is going to be very quick. There are a lot of factors in food security and food insecurity. Price is one of them. I'm going to talk about a financial structure that affects agricultural commodity prices. Okay, so just talk about a couple of food price indices and how they relate to food security. We'll talk a little bit about derivatives contracts and unregulated, both regulated and unregulated. Talk about how commodity index funds work, how they affect agricultural prices, and then I'm going to jump a bit and then to rules to reduce price volatility that's induced by commodity index funds, and then finally talking about G20, what the G20 has done and hasn't done. So the first, probably project that way. Okay, the food price index, which is most relevant to health, to national food security, is this kind of global food price index. Let's see if I get this to work. So you can see here in this study by Isabel Ortiz at UNICEF in 2011, it was Belarus that had the greatest percentage increase in the local food price index from May to November of 2010, over 40%. I mean, 4 times that of the Democratic Republic of Congo. And this kind of study is really important because the more famous
We're at the laptop.
Okay. Okay, there you go. So this is a much more famous food price index. An index is a composition of prices. And so, for example, this index combines 110 different food prices. They're called, it's freight on board prices, so that's the price of importing the food. And basically, freight on board is composed of the futures contract price plus the cost of shipping and the cost of insurance. Okay? And so this doesn't really tell you a lot, except that beginning in about 2005, you not only see that food prices begin to rise very sharply, but they also become more volatile. And I'm going to try to and over this period, it's much more relevant to look at sort of basic food commodities and how much did those prices rise. So 2002 to 2006, even prior to the financially induced crisis, you have wheat increasing 63%. But then it really starts to take off in January of 2007. And then it collapses following the collapse of Wall Street, the flight of capital from commodity markets. Once the governments rescued the financial firms, then it began to go up, and so in the case of wheat, goes up 48%. Now, the reason that you want to have a well-regulated futures market is that futures markets affect physical prices. They are supposed to be the benchmark prices for physical auctions, such as auctions of livestock. They are supposed to function as the reference price for physical term contracts. So in the United States and large agricultural countries, farmers usually sell a portion of their production prior to harvest. And that's so that they can finance the costs of production. And in the case of energy contracts, the oil and gas contracts, you have assessed prices that likewise are based on the futures market. So commodity index funds. You bundle up to, it's actually more than 24 contracts, but typically these contracts include energy-dominant compositions. And so that means that if energy, which is a more volatile sector, goes up and down, it takes agricultural prices with it, regardless of the market fundamentals. The reason that these exist is that the investment banks say that putting 24 commodities together is just like putting 10,000 equity or bond issues together. Obviously, this is not the case, but the purpose is supposed to be for investor portfolio diversification. One thing that's extremely important about this is that the investors who invest in commodity index funds are pension funds, endowments, and so they're betting long. They bet to increase prices, and they bet over the long term, regardless of market fundamentals. And what drives these prices is that the funds are so huge, in the hundreds of billions of dollars. And they create volatility because they are always selling the contracts before they expire. They never take delivery of the commodity. And when they roll these contracts, buy them and sell them, because they're traded over the counter and not reported, they create a lot of rumor, and the rumor drives volatility. And the commodity index funds drive out commercial hedgers who need to use these markets. This is just a real quick illustration. 1995 to 2000, prior to major deregulation of commodity markets, commercial hedgers here are purple, and they are about 2/3 of the market. By 2006 to 2011, they're only 1/3, and that third has been replaced by the index fund investors. So this gives you a quick picture. You've got about $260 billion here at the peak. These are all invested to increase prices. You have a crash in 2008. Everybody gets out. The government comes to the rescue, and long positions start rising again. You have volatility in unrelated markets because of the bundling of the commodity contracts. Whoops. Get this back. All right, so next please. So this is, it's hard to see from that IMF index how volatility affects a single contract. But the MXG is my hometown, Minneapolis Grain Exchange. And this is the volatility for hard spring wheat. You've got 161% average increase in monthly volatility. The prices that you're seeing there correspond to a really great difficulty that commercial hedgers such as bakers have in managing their price risk, because when it's that volatile, the cost of collateral becomes so great that they just leave the market and hope they can buy on the spot market. Another factor that's exacerbated prices and price volatility is the rise of high-frequency trading in commodities. This is a study from two economists at OCAD based on the Thomson Reuters tick data. And as you can see right here in West Texas Intermediate crude oil contracts, in corn and soybean, sugar, wheat, light cattle, beginning around 2009, the contracts just explode in their number. And this number, because it's traded, so much of it's traded over the counter, creates huge rumors and huge volatility. So, very quickly, some proposals: ban commodity index funds. This is very difficult to do in the United States because you have to demonstrate in U.S. law that it's a fraudulent activity, not just a harmful one. We do have a rule to limit participation of financial speculators in commodity markets. It's being litigated right now in the courts. Very important to aggregate positions across borders, because otherwise the banks will manage to evade the national regulations. It's extremely important to have near real-time and uniform reporting of the over-the-counter components of these funds, because otherwise you have no price transparency. And you have to ban privileged access to high-frequency trading for execution. The G20 approach to food security. So about half of all food insecure persons on the planet live in G20 countries. Nevertheless, Russia is not calling a meeting of the agricultural ministers during his presidency. And the G20 assigns food security to agricultural ministers, even though the finance ministers have huge influence over the financial regulation structure. Creation of the Agricultural Markets Information System in 2011 is an attempt to get the G20 member states to cooperate